Which days are really dangerous for you as a developing day trader? Often it's the really low volume days, the slow days. Why? Because you talk yourself into bad trades with a poor risk reward, which invariably lose you money. But if you want to avoid this dangerous trap, you can instead adopt a simple option strategy and capitalize on those exact same slow trading environments. I'm Mike Bellafiore, and we're a long-standing proprietary trading firm in New York City with numerous highly successful traders, almost all of whom started their trading careers with S&B. We hope you find this channel to be the top destination for you to learn and grow as a trader.
Hi, I'm Seth Froyberg, and I'm the head trader of SMB Capital's options trading desk. And the traders on our desk are often faced with the fact that on certain days, the market is simply just chopping around and not really moving in a tradable direction. I'm sure that all of you have encountered that at one time or another, and you know how frustrating it can be. Well, in this video, we're going to share with you an example of the kind of trade where you turn that whole situation on its head. And instead of pulling your hair out looking for trades and kind of talking yourself into taking trades that your gut tells you are more like coin flips, instead of doing that, you can instead apply your capital to a trade that does phenomenally well on slow days. And the great part is that it's really easy to learn, and the trade from start to finish takes just one trading day to complete. Now, in order to go over how this options strategy works, I need to make sure that you're clear on how equity options work. And I realize that most of you probably know something about how options work, but just for a quick review, and this will be fast. What's known as a call option on a stock entitles the buyer of that option to purchase 100 shares of that stock at a certain price called the strike price of that option, regardless of what price the stock is actually trading at. What's called a put option, on the other hand, entitles the buyer of that put to sell 100 shares of a stock he owns at the strike price of that put, again, regardless of what price the stock is trading. The buyer of the option pays what's called a premium to the seller of the option because the seller of the option is taking the risk that the stock will go past the strike price of the option, in which case the buyer can exercise his option. So in the case of a call, even if the stock's gone way above the strike price of the call buyer can exercise his right to buy 100 shares at that strike price. In other words, he's entitled to buy the shares way below market. Or conversely, on the put option, even if the market goes way below the strike price of the put, the buyer of that put option has the right to sell his shares of that stock at the strike price of the put option that he's bought, even if the stock price has gone way below the strike price of the put. In other words, he gets to sell them way above market. So naturally, all other things being equal, when a stock price goes up, a call option for that stock will go up because that right becomes naturally more valuable to the buyer. And when a stock price goes down, a put option for that stock will go up, because that right naturally becomes more valuable to the buyer of the put option. But it's also important to keep in mind that at expiration, if you've sold a call and the market closes below the strike price of the call, then unless the call was previously exercised, that call expires worthless and the call seller just pockets the premium. Similarly, if you've sold a put and the market closes above the strike price of the put, then unless the put was previously exercised, it expires worthless and the call seller just pockets the premium. So that's the basics of call and put options on equities. Now, keeping that in mind, let's head back to the very last trading day of last year, December 30th, 2022. And as you can see, Tesla, one of those popular trading stocks, had fallen all year and had closed on December 29th at just around 122. And so the next morning, with the stock opening up a little bit higher, suppose that the trader decided to enter into a one-day trade under the assumption that today is likely to be a quiet day on the market. And so he goes up about 3 points to the 125 strike price and sells 100 calls, then heads down to the 115 put strike price and sells 100 of those, while simultaneously buying for protection 100 of the 130 calls and 100 of the 110 puts. Well, when a trader executes a trade like this, selling calls and puts a certain distance above and below the stock's price, and simultaneously buys calls and puts farther away from the stock's price, when he does those four things at the same time, he's executed what options traders refer to as an iron condor trade, which, as you'll see, is ideally suited for when you don't expect a stock to move very much. Now, let's drill down a bit into the cash flow of this trade so you can understand its risks and rewards. And so first off, we sold the 100, 125 calls for 85 cents. And because each options contract represents 100 shares of stock, you multiply that price by 100, and we sell 100 of those. So we multiply it by 100 again. And the resultant cash flow for the 115 calls was $8,500. Now, we also sold 100 of the 115 puts for 31 cents, which, using the same logic, provides us with $3,100 in cash. And while at the same time buying 100 of the 130 calls for 15 cents, which is a cost to us of $1,500. And as you can see from the math, the 110 puts also cost us $500. And so when you net it all down, the resultant cash flow is $9,600, which flows right into your account. Now, in order to do this particular trade in this size, you need to have $40,600 in your account, which is its worst case scenario. But of course, you could cut your size down, take a smaller trade if your account size warrants it. Okay, so remember, the Tesla options expire that very day. And so let's move to the end of the day. And as you can see from the price chart, Tesla kind of chopped around during the day, and in the end closed at 123.01, which was only a 1.36 up move from the previous close, a very modest move for a stock like Tesla. And so now each of the options can be finally valued. And so let's take a look at how that turns out. And as you can see, that's a pretty easy process, because after taking into consideration that $9,600 that we first received when entering the trade, the rest of the options comprising the Iron Condor expired worthless. Why? Well, you see, the 130 calls that we had bought and the 125 calls that we sold, well, both of those expired above the closing price of 123.18. And so those are going to expire worthless, because no one's going to exercise their right to buy Tesla shares at prices above market, obviously, right? And the same goes for the 115 puts and the 110 puts, forming the downside portion of the Iron Condor, because no one, again, will sell their shares of Tesla at either 115 or 110, with them trading in the open market at 123.18. And so obviously they expire with no value either. And so the resultant profit is simply that original $9,600 in cash flow that we originally received earlier that day when we entered the trade, a return of over 23% in a single day. And this kind of profit is possible on a day where you expect the market to be sluggish and choppy, as is often the case right before a holiday. And so what I'd like you to take away from today's video is that traders don't have to struggle to make money on quiet days in the market. If you're trained in fundamental option strategies like our traders here are, you have a playbook that works on volatile days as well as calm days. It's indispensable as a professional trader to have a playbook for each market environment, and it's just as indispensable for the independent trader like yourself.
Okay, it's great to make money on the slow days, but you also need trading strategies that work in volatile environments. Well, that's if you want to be a consistently profitable trader. That's why you need to check out the video which teaches you how to generate cash flow during earnings seasons, appearing on your screen right now.